Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets. He's going to be there to help answer your questions. Now, if you are in the recorded version, we're glad to have you with us as well. You get to participate in the conversation by leaving comments in the comment section. But for all of you here, participate in the chat. Cameron's already started to post some stuff up there, including the fact that you can follow us on X at Ben Watson CS, at Cameron May CS. We'd love to have you do that and join us in that conversation. Speaking of the conversation, we're going to talk a little bit about our 14 DTE, 14 days till expiration, 7 days till expiration strategy that we've been following for a while. We're also going to talk a little bit about maybe looking at some summer doldrums when it comes to volatility. And we're going to look at a couple of positions that we have that maybe need a little bit of cleanup. So we're going to jump into that here really quickly as we get started. But once again, thanks to all of you. Welcome to all of you. We're grateful that you are here. A couple of quick housekeeping items. Remember that everything we talk about simply for illustrative and educational purposes only is not a recommendation or any kind of investment advice or recommendation about a particular strategy or circumstance. Now, past performance, no guarantee future results. When we talk about trading options, equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. It's not a guarantee future success out there in the real world. It is, however, a great learning environment, and there are some differences between the paper money platform and the live platform, namely studies and how they're applied in scans and on charts, and in the facilitation of early assignment of short options. Now, in our discussion today in index options, one of the reasons for trading index options potentially is to avoid early assignment risk. Now, we've talked a lot about that in a variety of different ways, but just remember that European style index options do not have early assignment risk. Also, remember that index options are cash settled. That is different than an equity option that settles to shares of an underlying stock. So we'll talk about that as we get into this discussion. Also, remember that we're going to use technical analysis in this discussion. If we talk about stop orders, which we probably won't in this particular condition, but if we talk about stop orders, remember that they specify the activation price, not the execution price, and there's the possibility that that order could get filled at a substantially different price. So with all of those things in mind, let's jump into our discussion here, and let's take a look at what's going on out here in the market. I'm going to first look at what's going on with the SPX. Also, this is a good opportunity for me to remind you to click on that subscribe button down at the bottom of the page, that subscribe button, and I'll show you what that gets you to here in just a few minutes. But that subscribe button helps to bring this content not only in an easier fashion to you, but also to other people as well, as does clicking on that like button. That lets us know that you enjoyed this webcast, but it also helps to bring this content up to the top of the algorithm for somebody else. Now, Chuck asks a great question. Is it better to trade European than American style options? And that really depends on what it is you're trying to do, because when we're talking about index options, we're talking about trading a product that is cash settled. But one of the benefits potentially of trading an index option is that it eliminates that early assignment risk. So we'll keep that in mind, and we'll talk about this in this discussion. But the SPX starting to see a little bit of a move to the upside this morning. Not much of one, however. A little bit of a gap up and a bit of a rally into kind of this hanging man candle, which was about how yesterday started and then finished a little bit higher. But it seems as if we're slightly breaking above that resistance area. RSI moving a little bit higher. The NASDAQ, this has been toggling kind of back and forth between green and red most of the morning. Again, a little bit of a move higher above that resistance level. The RSI a little bit stronger here, knocking on the door of that overbought area in the RSI this morning, but coming off of the highs as we're watching. The one that is kind of moving in maybe a little bit different, one of these things is not like the other perspective here, is the Russell 2000. And the reason that I bring this up, one of the reasons perhaps that the Russell 2000 is doing this is the ISM, the service manager's measurement of the services sector. That ISM number came in below 50. So most recent number coming in below 50 indicates a contraction in the services sector. Many of the companies that exist within that services sector, within that kind of space, if you will, fall within the small cap space. So a contraction in the small cap, or a small contraction in ISM numbers, in the service numbers, would tend perhaps to have a little bit more of an impact to the small caps. So we're seeing the small caps running into this resistance level, the Russell 2000 being the small cap index, running into that resistance and maybe pulling back a little bit. We're also seeing the RSI moving a little bit lower. So that sets the stage. One other thing I want to use to set the stage here in this discussion is I want to come down here to our VIX grid, the volatility index. And I drew this diagonal trend line in here last week as we were looking at the VIX, and it was kind of making that bounce along the bottom. I'm going to zoom in here, and we can see that the VIX today bleeding a little bit lower below that diagonal trend line. We're now down in the 17 handle. The average price, or the average number for the VIX, for the volatility index, if you look at this over a longer period of time, 10, 15-year time frame, the average number is in the 17.5 to 18 handle, somewhere around 18. So we're a little bit below the average. The average, you can see, has been coming down. This is indicative and very typical of, can you say that? Can you say very typical? Cameron, help me out with that one. Is very typical redundant, or is typical just enough by itself? We're at a point where, from a summer perspective, the market's kind of rolling into that. Remember that sell in May and go away mythology and heuristic that a lot of people use? I think there is some truth to that, only in the sense that the summers tend to get a little bit less volatile, not from a news perspective, just from a general activity perspective. So we tend to see that time frame be a little bit less active. Now, that being the case, that doesn't mean that the VIX can't explode, because it can and it does even during summertime, right? But the VIX has a tendency to fall and become a little bit lower as complacency reigns, as kind of news gets digested. So we've seen some of that news happen. We've seen some little spikes, and it certainly seems, barring something else that's kind of that black swan, which we can't know about in advance, volatility seems to be falling a little bit. So that would be suggestive of maybe a little bit cheaper premiums for buying options, but also cheaper premiums for selling options. So that's going to play into some of our structures, including our 14-7 strategy. So let's do this. Let's go over to our monitor tab, and let's take a look at our index options weekly group, organizational group that we've structured here in this page. Yeah, Carol, you're absolutely right. It did last year. I mean, it kind of ground down last year. So here we are, 7 days to go. Last Wednesday, when we were together, we sold the 5,700, 5,680 short put spread, which is bullish, has a bullish expectation on the SPX, on that index. We sold it for $2.40. Implied volatility, the VIX, was still a little bit higher at that point. VIX has come down since last Wednesday. So that's worked in our favor in this particular case, because we sold it to high. We want to buy it back low. And that's worked in our favor, as has the passage of time, as has the price to the index moving higher. All three of those things, all three of those influences working in our favor, because this spread right now, which has 7 days to go until expiration, has eaten away, has decayed away, has lost all but 35 cents of its value. Now, here's the thing to think about, right? If we think about this spread, and because this is where the questions start to come in. The questions are, why don't we, if it's at 35 cents, why don't we just leave that, right? Why do we buy it back? Why are we going to buy it back? Why not collect another 37 cents on this $2.40 premium that we brought in to begin with. And here's the reason why. Because there is risk. In fact, there is the entire amount of risk in this spread still to be had, even though there's only another 7 days to go. Now, we've collected, in this particular case, about $2 of the $2.40 premium. It's about 80. I'm going to just ballpark that and say that's about 80% of the theoretical maximum gain that we could get in the trade. And so if we were to take this off right now and book this, now we're taking the majority of that gain that we can take in the trade, and we're eliminating that risk. What we're gonna do is actually initiate another one. But if we were just treating this as a discrete, in and of itself, just one and done type of perspective, that's the thought process behind closing a trade like this down prior to expiration positively, instead of letting it go through expiration. So we're willing to sacrifice about 20% of that profit in that trade for the sake of letting it do what it's going to do, and then eliminating that risk, because the risk is still here, right? In this particular trade. So look, we had a $20 wide, vertical spread. So we had $18.60 of risk in the trade that still exists. So let me ask you this in terms of the trade-off here, and I'll just kind of weigh this out. And this is the trade-off, and sometimes it takes just visualizing this, right? So $18 of risk versus 37 cents of gain, right? Now, Chuck, we don't have assignment risk because these are European style options, and that's a great question to ask. We don't have early assignment risk, so we don't have to worry about that early assignment. But we do have the potential risk that the price of the index goes up or excuse me, in this case, goes back down through our spread, which at expiration would put us in that maximum theoretical loss potential, right? So do you want to hold on to $18 of risk for the sake of picking up an additional 37 cents, right? That's nickels. I like that. Sell for 80% to avoid the descent. I like that, Kevin. That's good. That's picking up nickels ahead of a freight train, right? Okay, cool. So as we think about that, that's kind of the consideration here. So let's pull this trade together. I'm going to clear those annotations, and we'll kind of look at what we're going to do now. So we know we're going to close this one down. So I'm going to do that first of all. I'm going to close this trade down, simply right-click and create a closing order, and buy that one back. And we're going to sacrifice about 40 cents of that premium that we brought in, and I'm okay with that. We're going to read through this order, make sure that it's to close. We're going to close down that position, and we closed it down. Okay, cool. So this is pretty liquidity. I'm gonna do that. I'm gonna be doing that, Martin. I just have to confirm that I can show those previous results. So we're working towards that. So stick with us. Now let's go to the trade tab here and our option chain. So now we're going to go out to 14 days to go until expiration, right? So we've talked about that, and that's a good question, right? Closing them down if they've gotten to a profit potential. So for the sake of the integrity of this structure, now you could certainly do that, and we could do trades right that in this particular case, but the structure of this is we're simply going to take it as it come what may, right? Close it down with a loss, close it down with a gain at 7 days. And Isaiah will talk through this, and I'll show you what the thought process is behind that reward to risk ratio. Because yeah, it is a little bit low, but we're talking about probabilities here, right? So we're going to go to the 18 June expiration. We know that that's going to be our 14 days to go until expiration. We can see that here on the option chain. 14 days to go until expiration. So we're still looking at the SPX. I'm going to go to my chart, and I'm going to change my grid to my index. Let's see where that is. There it is, index options grid. And we're going to put on the SPX. And so what I have on this index options grid, and by the way, the link to this grid is in the description page for this webcast, but I will go ahead because I like you guys. I'm going to go ahead and share this grid with you as well. Remember, anytime we share these scripts, this is for illustrative and educational purposes only, and it is not a recommendation. It is not guaranteed as to time or accuracy, but I just shared that grid with you, right? Okay. So as we look at this trade, here's what I've got. I've got on this chart on the left-hand side MACD and the 200 period moving average. And the rules so far, the idea behind this strategy so far is when the SPX is above the 200 period moving average, we sell put spreads. When the index is below the 200 period moving average, we sell call spreads. Okay. All right. So what we're going to do now is we're going to look on the right-hand side. And on the right-hand side, I have implied volatility. You can see that implied volatility is pretty low, right? That's the VIX. That's what we were just talking about with that lower volatility. And you can see where the index is right now, currently sitting at 5987.05. So this curve that I've got here, this probability of expiring cone, that purple line, shows me a 1 standard deviation range above and below where the price of the stock is at any particular date out in time. So I know that my 14 days to go until expiration time is 6/18. That's June 18th. So I'm going to put a time hack. I'm going to put a vertical line on that particular date. And so we're going to go to the 18th, and I'm just going to put that right there. That's my vertical time hack. That's in the drawing tools, and it's called time level. Okay, so just using that as a time hack. So what we're going to do, since we're selling put spreads, is I'm now going to sell my put spread where those two lines cross, where that cone crosses, where that cone crosses my vertical time slice. So that's going to be right here. And I'm just going to kind of it's going to probably be right about 57.80 is where that hack is. Now, I left on here the last, I'm going to just put that in there and just going to try to get that flat. Okay, so what I want to do is I want to look at, guys, the last 4 trades, or actually the last 3 trades that we did in this strategy. So there's one, there's one, there's one. Those are the last 3 trades that we sold, the last 3 put spreads that we sold. You notice where they are? Notice that they are a little bit further out from that cone, that probability of expiring cone. What that also tells me is that implied volatility was likely a little bit higher when we put those trades on. So we were able to sell a little bit further out. Now that implied volatility has contracted, we're selling a little bit closer, right? We're selling a little bit closer to where the price of the index is. That's simply a function of implied volatility. Implied volatility is lower expected move. So where we get that 1 standard deviation line, that's a function of implied volatility. That also comes in a little bit. So that means that this cone has narrowed over the last few weeks. That's expected when implied volatility goes down, right? So that is something that we're talking about. Now, let's look and see where that 57.80 is on the trade tab. So we're going to come down here and I'm going to open up this option chain, and I'm probably going to have to add a bunch of strikes. So we're going to go to the 57.80 put spread. Here it is right here. That's about the 15 delta. So we've been in as close as the 17 delta. I might even come in a little bit there from that 57.80. That's about the 15 delta. I'm okay with that, though. Fairly narrow bid-ask spread. It's about 30 cents here. That's okay on an index. But if we can create, so what I'm going to do is I'm going to create In this case, we may even bring that risk to reward down a little bit. But think about this. That 15-cent delta suggests a level of probability. So to go back to Isaiah's question, what's the thought process behind this risk to reward? It seems pretty low. Well, what's also low is the probability that this is going to end up in the money at expiration, right? Because it's at a 15 delta, which means that it has about a 15% probability of being in the money at expiration, which means that it's got about an 85% probability of being out of the money at expiration, which is what we want. So it's got a higher probability of being successful. And it's kind of a characteristic of behavioral finance that suggests that we tend to underweight high probability scenarios. So we tend to discount the fact that, hey, this is highly likely to end up out of the money, unless there's some kind of black swan event, which we don't know about. So we can't factor that in. So if we look at putting this trade on, this is a highly probable trade, and that's why we're willing to bring in a little bit less reward for this trade versus the risk that we're taking, right? Chuck, I'm okay with that. And I'll tell you, if we were to look, and so we can look at let's change our delta theta vega to volume and open interest. If we've got a strike around there, so we're looking at the 5780, that's got 18 contracts in open interest versus the 5775 or versus the 5785. Now, if I start coming in a little bit too much to the 5790, then my probability changes a little bit. Then I'm getting a little bit more open interest. So if the bid-ask spread is relatively narrow, I'm okay with that. I'm okay with a one-lot trade at 18 contracts of open interest. That's just fine, right? In that particular case. So if we think about it from that standpoint, small fish, big pond, if I'm one contract in an 18 size pond, 18 contract pond, I'm still a small fish in a big pond. Not as small a fish in a big pond if I were in an 80 contract pond. Does that make sense? But I'm bringing in less premium. So I got to kind of balance this, right? So we're going to go to the 5780. I'm going to sell the 5780, and we've been making this 10 or 20 points wide, right? So if I go to the 5760, that's going to make it 20 points wide. That's consistent with the trade that we put on last time. So let's do that. We'll go to the 5780. We're selling the 5780. We're buying the 5760, 20 points wide on the vertical spread. And we're bringing in $2.15 of credit. That's not as much as we brought in last week, but volatility is contracted. So that's okay. And that's to be expected, right? And if we click on confirm and send, we can see what the risk to reward is here in this particular case. Maximum theoretical gain. We know that we're probably not going to get to that maximum theoretical gain because we're going to take this trade off prior to expiration. But we know what our risk is, but we also know what the probability of the trade is, right? So that's kind of the thought process in putting this trade together, right? And you're absolutely right, Chuck. As we start to get closer to that, there's going to be more liquidity. It's going to make it easier for us to get out of the trade. Theoretically, not a guarantee of that, right? But we kind of have to keep these things in mind and talk through these probabilities. So let's look at put it in this group, our index options weekly group. And we're going to click on send, and we're going to fire this order off. So we brought it in $2.10, $20 wide vertical spread. And let's go back to our monitor tab. And so here we are, 14 days to go until expiration. We took that one off, and we're going to close this one down at 7 days to go until expiration. So the reason for, and this is the next question that oftentimes gets asked, the reason for 14 and 7 is this, okay? So we're selling a far out of the money option, right? It's primarily time decay in this particular case. This is expiration, right? If this is expiration, and here's 14 days to go until expiration, and here's 7 days to go until expiration, an out of the money option. So both of these legs are out of the money. And we want that short leg to decay away as quickly as possible. So here's what that decay curve looks like. It doesn't look like an in the money or an at the money option. It looks like this. So the greatest amount of time decay occurs in that first span of time, that first iteration. It doesn't matter, guys, honestly, if this were 7 and 0, right? Or if this were 30 and 15, right? It doesn't matter. What happens in an out of the money option is the greatest amount of theta, because of the convexity of that theta curve, the greatest amount of time decay is going to occur in the first section of that time decay curve. So in order to capitalize on that, we're doing that. We're selling at 14 and buying back at 7 so that we can take advantage of this greatest rate of time decay. Because as we get closer to expiration and this option is still out of the money, that rate of time decay gets very slow and we have to be very patient. Okay. So that's why we're doing this in kind of this time frame. Now, a couple of the questions that come up, and this is a question that comes up quite often. Well, do we want to put a stop loss on this? Because if we open this up and we say, look, we've got a potential risk in this trade if this goes against us, and the answer is no. We've already defined our risk in this trade. This is a risk-defined trade. And the reason that we maybe wouldn't put a stop loss on this trade is because there is the possibility, right, that we could be triggered out of that trade if the index moves pre-market, you start to get some pre-market adjustment and start to gap around, and then it comes back in and it kicks us out of the trade, and then we ultimately end up getting into a position where it would have been a winner anyway, right? So we're defining our risk, we're comfortable with the risk in the trade, and we're not going to put a stop on this. If you want to, you can. That's fine, but it's already a risk-defined trade, right? If you're concerned about that potential, the magnitude of that risk, then decrease the width of the spread, but it's also going to decrease the amount of premium they bring in. So this is what we're going to look at doing here in this particular case. So it's already kind of working against us a little bit, which tells me that the index is maybe moving down just a little bit. If we were to go to the charts, I can see that that index is coming back in just a little bit from where we were. It's at 59.80 right now. So it's coming back down a little bit. And that would be the reason why that trade is kind of starting to work against us just a little bit here. So that's our 14.7 strategy in this particular case. So two other strategies that I wanted to look at really quickly here. So I'm going to go back up here to my index options. And this is a trade that we put on last week. I think it was last week, if I remember right. Let's see when we put this on. 5/21. No, that was 2 weeks ago. All right. So here's the trade that we put on 2 weeks ago. This is this vertical spread on the Russell 2000. It is a short call vertical. So it is benefiting if the index moves to the downside, which, if you remember, we looked at our chart, we saw that the index was moving to the downside. But now here we are 9 days to go until expiration, right? So this vertical spread, so we sold it to begin with. So if we could buy it back for $3.50, we've made a little bit in this trade. We sold it for $5. We could buy it back, in this case, for $3.55. It's done not quite half of what we would expect it to do, right? Ed, you're going to have to look and see if on your account if that is the case, right? Okay. But this trade has done a little bit less than half of what we expect it to do. So if our expectation is that, let's go back to our index. Actually, let's put it right here, RUT, that the index is going to continue to move to the downside. We're going to keep this trade on because, remember, we don't have early assignment risk here, right? So we're going to keep this trade on. We're going to keep that working in our favor in this particular case, and see how low we can buy that back. In fact, what we might even do is we might say, fine, let's buy this one back, and I'll just create a closing order here. So this goes back to what we're willing to take this trade off for. So as opposed to putting a stop order, I'm not opposed necessarily to putting on a limit order that says buy this back when it's done some of the work that it can do for me, as opposed to putting a stop order on. So if we sold this originally for $5, now if I want to get out of this for half of that, right, for half of that theoretical maximum gain, I'm going to put a limit order on for $2.50. So if this does move down, start to decay away, or we get a big move to the downside in the index, but I'm not able to watch it, then it's going to take that trade off at 50% of that theoretical maximum gain. And I'm okay with that. I don't expect a short call vertical spread on an index to be a home run hitter. So, I mean, you might put a trade on to take this off at 80%. Some traders may put a trade on to take it off at 85%. I'm willing to put this on so that we can illustrate this to take it off at 50%. And so I'm going to click on confirm and send, read through the order, make sure that that's what I want, make sure that that's to close, and I'm not opening a new order. And I'm going to look at taking that trade off if it goes to $2.50 or less, right? All right. The other thing that I've got here in this trade is I've got this one. So this is an XSP long put. We bought it for $4.80, and we used this as a hedge. If you remember, we hedged against downside movement in the price of in the overall portfolio that we're looking at, right? So here we are with an XSP. This is the S&P 500 mini contract at the 589 strike. It's out of the market. And if we were to look at the trade tab for XSP, we're now down to 1 day to go till expiration. We've got this option in place. And here's our put strikes. You can see how far out of the money it's at. Let's change our layout to Delta, Theta, and Vega. It's at about the 8-cent delta. Very low probability of ending up in the money at expiration. It's 1 day to go until expiration. It's lost the majority of the value that it has. So we can do one of a couple things, right? We could look at rolling this and turning it into a vertical spread, or we could turn it into a vertical spread close to expiration and use this as kind of we've already decayed away the cost. We've already paid that cost, but we might be able to recoup some of that potential by turning this into a short put vertical spread if our expectation was that the XSP was going to make a move to the upside, or stay where it is, right, and not move down. I mean, it's at the 7-cent delta, right? It's at the 589 strike, which is a few strikes out of the money. So if we've already long that, and we've got 1 day to go until expiration, and we don't have early assignment risk, then instead of buying this back, selling this back and just collecting that 22 cents that's remaining, what if we turn this into a short vertical spread? Because realistically, we're not necessarily increasing the risk that much, right? In this trade. The risk is in this trade what we paid for it. Well, what if we turn this into a short call vertical spread, short put vertical spread in this particular case? So I'm going to go back to those charts again, and we're going to go back to the SPX or the XSP in this case, so we can look exactly at where that is, and that XSP. And here's our strike, the 589 strike. So that's right about here. So what if we turn this into a vertical spread at this 593, what is now a support level, right? At this 593 support level, 593, 594. So we're going to go back to the trade tab. Here's our 594. That's about the 20-cent delta. But you know what? Here's how long we've gotten this trade. Today and tomorrow, right? Today and tomorrow. So if we were to put this trade on and leave this trade through expiration, right? Now we're not at a 0 DTE trade. We're at a 1 DTE trade. So putting this trade on, we shouldn't encounter any of those challenges to initiating a 0 days till expiration trade. We still have 1 day to go. But the potential movement, if we look at what the potential movement is, based on implied volatility in the next day, it's $4.29, right? So where is the price of the index right now? It's at 598. Okay. So if we sell the 594, we're just about at that expected move. And guess what this number often does? Overestimates the potential move. Now, barring any news, we're going to turn this into a short vertical that's likely to end up out of the money at expiration. So we're going to go to that 594 strike, and we're going to sell that 594 strike. And we're going to bring in 78 cents. Now, we've already paid the premium on that long option, and we've lost most of what we paid for it. So all we're doing here is we're recouping 78 cents against that. So think about what that means is we're just bringing in a little bit of premium to maybe offset about 78, 75 cents of what we've already lost in holding onto that long option. All this is doing is helping us to recoup some of that. But it's creating a trade, right? How do we know? Okay, Dragon Rider asks the question, how do we know what the expected move is, right? That's where implied volatility comes into play again. This number right here on the right-hand side tells us the current level of implied volatility for this expiration, and based on that current implied volatility, what the expected move is between now and expiration, right? So $4.29 roughly, up or down. So if it moves $4.29 up, cool. If it moves $4.29 down, well, it puts us at a potential loss, but we've already taken the loss in the trade. So we've got the right to buy the index or to settle the index at 589, and we're creating the obligation at 594. So we're still kind of defining our risk in this trade and putting this trade on based on that idea of recouping some of our expectation in this trade. So I'm going to click on confirm and send. Again, read through this order. Now this is to open and initiate this transaction. Now, because we already have the long put, this is not simply a cash secured put. So you got to think about it, right? Even though this initial order says, this order trade page says, max theoretical loss, 59,328, notice the buying power effect. The buying power impact comes from the fact that we already own that long option, and it's defining our risk in the trade. So we're going to put this in our index options group, and we're going to click on send, and we're going to fire that order off. Let me kill that annotation, and it just filled for us. And so now what we're going to do is we're going to go back over here to our monitor tab, and here's what we have. We have essentially what's left is a 20-cent long option and a 73-cent short option. That's what's left. We got to kind of divorce ourselves at this point from the fact that we paid $4.80 for that long option to begin with. So here's what I'm going to do is I'm going to change my gadget here to my calculator, and we're going to say, look, we sold it for 73 cents, and we've got $20 of residual value in that other one. So we essentially sold that 1 day to go until expiration, vertical spread for 53 cents is what we brought in. Okay. All right. So that's turning a long option, and part of what allows us the freedom to do this, the luxury to do this, is the fact that we don't have that early assignment risk, right? We could even sell a little bit closer to that expiration. Remember, these are cash settled, so it's not like we're going to end up having a short position or a long position in the XSP, because there is no long position in the XSP. There's only cash. So we're simply using this circumstance to be able to kind of not fix, not repair, but recoup some of the loss that we took in that long put option to begin with. So we're creating this long vertical short vertical spread in this particular case. All right. The last thing I wanted to think about doing here in this particular case, and it's something I wanted to consider. So we've done our 14 days to go until expiration, but the VIX is also an optionable instrument, right? So if we go to the trade tab and we go to the VIX, this has European style optionable strike prices, right? The problem with this is these are AM settled. So they take the number to settle that option that prints the next morning. We've talked about AM settlement before. So there is overnight risk in VIX options. But my thought is volatility is contracting and continuing to contract. So my thought being this, in doing this, is a fairly short-term, short call vertical spread on VIX options. And the reason for this is, again, not looking for much movement, just looking for this to continue to settle a little bit in this particular case. So NDX is XND, and there's, at the moment, Craig, not a really liquid product for the Russell 2000 for the micros or the minis. So let's do this. My expectation, remember I said that the volatility average is about 18. So I'm going to look at selling a short call vertical spread, assuming that, again, we're 6 days to go until expiration, right? And you're right, it has been. And Carol, that's why I saved this to the end, but we're doing this in a short time frame. And we're going to look at selling out here at about the 25-cent delta. Now, maybe even go a little bit further in because our bid-ask spread is a little bit different here. I'm going to go to the 20 strike. So I'm going to sell the 20, and we're going to buy we'll buy the 22. Let's see what we can get out of this. Getting 27 cents against the $2 wide. Probably not enough in this particular case. Let's see if we can do something else. Let's sell the 20, and let's buy a little bit further out. Let's buy the 25. That's a $3 wide spread there. Now we're getting a 36-cent credit on a $5 wide vertical spread in this particular case. I want to see how this plays itself out, guys. But the expectation here is, again, look, I mean, this is risk defined. We don't have early assignment risk. So we're looking at taking that potential gain simply to see implied volatility do nothing, right? That's the expectation here. So I'm going to put this in my index options group. We'll see if we can get filled on this. And it did. So we filled it at 36 cents. We're going to watch this over. And I love Carol's emojis there of fear and surprise. Let's see how this does. Let's see how this plays itself out, right? Because you're right. Volatility, barring news, volatility tends to drag lower. But barring news, I mean, if we get a news story or something that pops this volatility, yeah. Yes, it's bearish, Vic. Absolutely. We're looking for volatility to stay where it is or move down. And we're already low, just looking for this to grind lower. But you say that, I'm very brave, but what's our theoretical maximum loss in this trade for 6 days? $380. So think about it in that context. That's why we're doing this as a risk-defined trade. I know it sounds scary, but that's why we learn about these things and why we trade these things. So let's do this. The other thing I wanted to do here with you is, as we get into this, let me just do this really fast. I'm going to pop over here, and we're going to pop into the Trader Talks webcast page, and I'll bring this up. If you want to learn more about this, this is a great way to understand index options, a great way to learn a little bit more. Just type in on our Trader Talks webcast page, INDEX, index options. All right, there you go. Oh, hey, by the way, I don't know. we're almost out of time, but I think I saw, Cameron, help me out. If you'll scroll up in the chat, I think there was a feedback survey. I may have missed it until just now. But do me a favor, if there is a feedback survey there in the chat, go ahead and click on that feedback survey. Let us know what you think. Help us out, make these webcasts better. But this is how you can learn more about index options and really about any other topic, is going here to the Trader Talks webcast page on YouTube. Make sure you click on subscribe and like, and follow us on X at Ben Watson CS, at Cameron May CS. And we're going to be back next Wednesday to talk a little bit more about index options. We'll see you again very soon. Hopefully some of you are going to join us in Miami next weekend for our Market Drive event. You'll hear more about that in other webcasts as well. Have a great day, everybody. We'll see you soon. Bye-bye.